Welcome to Invest in Part 3. My name is Mensah Oteh and I'm delighted to be here with you as always. In today's session, we're going to be taking a little bit of a bigger jump into how to begin your investment journey and how to invest. I'm going to be talking about real estate. I talked briefly in yesterday's session about the 4 different types of investment vehicles that most people are familiar with. Now, just to refresh, perhaps those of you who were in part of yesterday's session, the 4 vehicles were businesses. You can invest in commodities, gold, silver, oil, and food produce. You can also invest in paper assets such as stocks and bonds. But finally, you can invest in real estate, or what some people call property investing. Now, in today's session, we're going to be going a little bit deeper. We're going to be talking about one of such vehicles. Now, I'm going to start with real estate for a number of reasons, and I'll explain as we go along why I chose to start with real estate first. But let me, like I always do, start with an opening statement. My opening statement today is simply that education and wisdom must precede your investment choices and decisions. Now, say that again. Education and wisdom must precede your investment choices and decisions. Without investing in yourself, in your education first, what you find that success could elude you. Success is something you attract. The only way you can attract success is you've got to be attractive. The only way you become attractive is you become wise, you become more educated, you become a lot more knowledgeable about the area you're trying to invest in. Now, that's the first statement I'm going to make. And the reason I've been emphasizing a lot of options and ways through which you can increase your wisdom is simply because I have a principle or philosophy that says you must teach people the why before you teach them the how and the what. Anyone can tell you what to do. Anyone can tell you how. But if you don't understand the why, then you have a void that is missing. And also, without the why, you don't have the strong foundation. Everything you see around you is a product of an idea. So what you have, like this pen I have in my hand, this is not reality. The idea that created this pen is what's real, because I can destroy this pen and it'll be gone. But if the idea that created the pen can be tapped into again, then we can recreate and produce more. So I always start by trying to emphasize on the importance of laying the right foundation before you begin any investment journey, and it's no different with real estate investing or property investing. In my opinion, I think there are probably 3 or 4 important guiding principles that I should perhaps begin with. Number 1, if you're investing, you must start by recognizing the value of wisdom. Number 2, you must recognize the value of discipline. Number 3, you must recognize and understand the value of, once you have the wisdom, once you have the discipline, you're going to find me talking about what I call the art and the science of investing. And number 4 is about taking action. Wise action. I should say before we proceed that there is no investment path, vehicle, option that will make you successful. Anyone who says to you that real estate investing or property investing or investing in stocks and bonds, investing in a business will make you wealthy is not being very honest. And the reason is simply because all of the ideas and all of the options and all of the strategies really come down to one important word. And that word is simply the plan. is your plan that makes you successful. An old ancient book says that you will make your way successful. In other words, the plan depends on the individual. So the investor makes the investment choice successful. It has nothing to do with the investment vehicle. All investment options and strategies have their advantages. Some have their disadvantages. Some have merits and some have, perhaps you might say, lack of that. But I started in session 1 by asking a question. The question was simply, what's your purpose for investing? In other words, what's your why? And I'll refer back to this as I talk about real estate. Now, the whole reason for bringing this back is because if you understand the purpose for your investing, for example, if you're investing because you need quick cash, you need money immediately, then that would decide and that would influence whether you go for real estate, whether you go for paper assets, whether you go for commodities, or whether you invest in the business. So your purpose guides you, and therefore you as the investor, you are the lowest common denominator. Now, I'm stressing that for a reason. I'm stressing that so you recognize that there is absolutely, from my experience, there is absolutely no investment vehicle that will make you successful if you lack the understanding, the awareness, if you lack the sophistication to be a good investor. You have to be a good investor first. So, to succeed in real estate investing, which is what we're talking about today, and I'll deal with the other investment vehicles as we go along. To succeed in real estate investing, your success will be based on, number one, your ability to increase your wisdom and consistently increase that wisdom and continue to grow, to learn, to study. Investing is a lifelong commitment. It's not something you simply do passively. The commitment is lifelong. In other words, the learning process required to stay as an investor is something you commit to long term. Meet anyone who is into or has an interest in investing, and they'll tell you that they read a lot, they study a lot, they analyze deals a lot, they collaborate, they learn as much as they can, because the quality of the information knowledge that you gain will always and seldom exceed. It will always decide your decisions, but it will seldom exceed the level of your success. So you must have wisdom. Your wisdom must be added to what we call discipline. And what you're trying to do here is discipline some of your habits. In other words, your spending habits. I talked about a formula for creating wealth. And the formula I provided was this. If you want to be wealthy, the first thing you must do when you earn is you must invest before you spend. I contrasted this formula with the formula for poverty, which is the poor people earn, but the first thing they do is spend. Unfortunately, they spend much more than they earn, in some cases, like I did for so long. Therefore, they have very little to save. But even if they spend less than they earn, there's so little left that they have to save actively. So the discipline in terms of habits, the discipline first is you have to discipline yourself to pay yourself first and invest that amount. And then discipline yourself to learn how to live on what's left. In this case, by S, I'm referring to spending. Invest first, discipline yourself to spend wisely. Now, I talked about the 6 rules of investing, and I said one of the most important rules is the discipline of having an automatic system whereby every month you continue to invest so that you take advantage of the compounding principle. But also I talked about the discipline of reinvesting what you earn as interest, dividends, or maybe profits. You reinvest it, and that way you activate the compounding principle, which Albert Einstein said is the eighth wonder of the world. So, wisdom is not just all you need. You need discipline. That discipline forms habits that you must live by. That habit creates your character. Now, once you've done that, you come down to what I call the art and the science that makes investment successful. Wallace Wattle said that there is a science to getting rich, and it's an exact science like algebra or arithmetic. In other words, if you follow the principles, if you follow the laws of wealth, if you obey the principles and obey the laws of wealth, then you will make your way successful. However, investing in itself is not a science, it's an art. Investing is an art. In other words, you have to tailor your investment decisions and choices to suit you, to suit your outcomes, your objectives, and your needs. So, investing is an art form. Wealth is a science. If you want to succeed in real estate investing, you must combine the science of wealth with the art of investing. And we'll talk about some of the art forms and what it really means, and how you go about learning the art form. But the point is, it's learnable, but now you have to tailor it to you, who you are. So I'm going to share in the next few minutes where I started from, my journey, but I want to make a point. I don't want you to simply copy what I've done. I want you to study. I want you to study other people, gather information from other great wise sources, because that's what I do as well. I learn from other people. But then sit down and decide what's right for you. Decide what works for you based on who you are, the vision you have for the future, your goals, your dreams, but also, more importantly, because you're going to be paying the price. So, listen to what I share with you, but decide for yourself. And then finally, you've got to learn how to take action. Now, taking action in real estate requires something that I talked about yesterday, which was mindset. In other words, I said you have to have the right mindset. And that mindset is what I call the entrepreneur's mindset. It's not about just taking action. You've got to have more than just action. You've got to have vision. You've got to have imagination. You've got to have perspective. You've got to have focus. Your ability to succeed in real estate comes down to, in my opinion, 4 factors. 4 simple factors. I'll just share that with you very quickly. It comes down to 4 simple factors. Number 1, you must buy or purchase at a price less than what is worth. Number 2, you must have the ability, either yourself or by delegating it, to manage strategically. Number 3, it comes down to your ability to arrange, apologies if my spelling is wrong, good financing. Number 4, select great deals. And this great deals has to do with location. Real estate. If you follow these 4 principles, you will make your way successful. It's almost a given. First thing you must do is buy at less than it's worth. Let me qualify that so you recognize that I'm not referring to value, and I'm not referring to price. You obviously want to pay less than it's on the market for in terms of its price. If you can get it for less, that's perfect. That's a great starting point. But your ability to use your entrepreneur and your mindset is what makes this so attractive. In other words, let's assume that a property is listed on the market for 400,000. That's what it's listed for. You might buy that property for 380,000. That's what you pay for it. You bought it below market price. What is the value of the property? Now, the value of the property could be 500, or the value of the property could really be maybe 385. It could also be less. It could be 370. So you start with the price. That's perfect. You think about the value. That's great. By thinking about the value, you must combine that with your entrepreneur mindset. In other words, you're thinking about, can the value be maximized? And also, will the value drop? Is it possible that what you're buying is a sucker? Is it possible that what you're buying is something no one else wants? That requires the right mindset. But the most important part of buying is the worth. What is it worth? Now, most people say that the value of something is based, or the worth of something is based on how rare it is, but also what other people are willing to pay for it. Now, by worth, you can buy this property. It could be listed for 400,000. You might buy for 380,000, but it's worth 500. To one person, to one investor, is worth 500. To a second investor, that property is worth 720,000. That's its true worth. Why? Because the second person or investor has a mindset that sees beyond sight. So they're able to use their imagination. Most people react using their five senses: sight, sound, touch, taste, smell. Very few people use their six higher faculties, which is where all greatness, where all success, where all wealth begins. Imagination, intuition, perception, reason, memory, will. This is where you start to create remarkable results. Imagination is whereby you can use your vision by seeing with your mind, not by sight. If you see with your eyes, we call that sight. If you see with your mind, we call that vision. So one person sees a property, an investment, and that's all they see. The second person looks at the same property. The property may be in a relatively old, derelict state, but they can start to imagine what they could potentially do with the property. Can you put an extension? Can you rearrange the building? Can you sublet it? Can you split it into different component parts? All of that requires vision, but all of that vision you can get. You don't have to get it from your experiences alone. It helps. You can learn from other people's experiences. Now, one of the things you'll find as we journey along is that I'm going to talk about a word. That word is the word leverage. And one of the most important forms of leverage in investing is the leverage of other people's experiences. In other words, you can learn from the experience of other people without having to invest the same time, energy, effort, and potential loss. So buying is important. Managing strategically is more important, in my opinion, because you can buy something, but if you don't manage it, if you don't maintain it, the value drops. It probably loses some of its price and its worth. So strategic management is key. then arranging good financing is important because as an investor, you're thinking about getting the best out of what you've paid for. It's about negotiating well, but the negotiation doesn't end in you actually speaking to the seller and doing a deal for $380,000. If you're going to use leverage, then obviously you're going to need partners. Now, you might decide to use debt to finance the deal, or you might decide to use equity partners to finance your deal. In both cases, it's simply a matter of bringing in people, using people's money to finance your deal on the basis and with the agreement that you pay them back a certain percentage every month, every year. The lower that amount is, the shorter the payback period, the more it favors you. I'll say that again. The lower that interest amount is, and the shorter the payback period, the more it advantages you. So for example, most people would think about a 30-year loan, for example, and they might get a 4.5% interest repayment, for example. An intelligent investor, on the other hand, is probably thinking about maybe 10 years and 2.5%. I will say this, however, I'm going to contradict myself. When we journey through the next few days, when we go into what I consider to be the game of investing and how the deals are done and where money is really made, I'm going to talk about debt. I'm going to talk about debt in more detail. What you find is most investors will try to maximize as much leverage as they can. So, although you're trying to pay back as quickly as you can, there are some circumstances and situations whereby it's not in your best interest. If it's your home, if this is your home, then certainly you want to shrink the payback period and reduce the interest. But if it's an investment deal, what you're thinking about is income. Therefore, it might be in your best interest to secure something longer, maximize the amount of debt you have on it, have other people pay for the debts so that the profit you make is much greater. Because investing, for most people, when they're talking about investing for wealth, it's all about income. You want to maximize your assets. You want assets to appreciate in value, but you're really focused on income, the security of your income, maximize income, increase net worth. So securing good financing is the key. You can have a great level of wisdom. You can find a property that is a great buy. You can have the ability to manage and partners to help you manage. But if you're going to use leverage and you cannot get good financing, then the deal is off. But also, if you can't secure good financing first, there's no need to go hunting for properties. Now, for a number of years, when I started my journey, I could sit down and review and analyze and do some due diligence on some potential properties. Obviously, I had an interest in it. I was trying to increase my understanding. And I spent a lot of my time dealing with analyzing deals, looking at options, whether it would work. I could spend a few minutes and I could look at a deal and say it's good or it's bad or walk away. But what I found was if you don't have financing, all of the energy you're spending analyzing deals could be used for more important things. My recommendation is put all of that in financing. Find the partners, find the equity partners, speak to the lending company, a bank, a building society. Secure financing, because once you have financing, you'll find a deal. I'll say that again. Secure your financing. When you find your financing, when you find your partners, when you find the best team that can make that deal move forward, I can guarantee you'll find an investment option for you. But the final thing I'm going to talk about is that you need to be able to select great deals. And this has less to do with buying It has everything to do with location. With real estate investing, real estate is only as great or good in relation to where there is demand. And there are normally three areas that I tend to look at. Number one, are there jobs in the local area, or are there jobs close by? Because where you have jobs, you have people. And if you have jobs, you're going to need residential homes, but also you're going to need commercial buildings. So if there's a demand for jobs in that area, then there's usually a much higher chance that there will be a high demand for housing. Number two, is there an educational institution? In other words, are there schools, particularly higher education? Because if there are students and it's a good school and the population is much, you'll find that you would have a need for housing, but you have a need for the buildings that the students are going to study from or study in, but you're going to need people to teach them. So you're going to need families. So it's a whole big, like a big bubble. You have the students, but to satisfy the students' need, you're going to need a teacher. The teacher might come with a family, but the teacher must also work from a building, and the family must live in a building. So you can see that there's a connection. But in addition to that, if there is a demand for education and there's a demand for housing, then obviously there will be infrastructure. And if there is infrastructure, there is more jobs. So it starts to almost escalate. So you must think about location. Where am I buying? What is the trend in the area that I'm buying in? What has the trend been in the past? What are the foresights? What are the future potential trends? Study the area quite well. Find out, for example, if there's a request or demand, an application for perhaps a number of more homes being built. Now this is key. Let me just spend 2 minutes and explain what I mean by that, because this is very important. Let's assume you buy a property for £400,000 and it's a commercial property, and you're able to generate £1,000 per month, and this is roughly about, let's say, 200 square meters. You look back at the trends and it's been consistent. Let's also assume that in the past 5 years there's been a 5% increase in what you get in terms of your rent. So the past identifies something secure. It's always increased every year by 5%. What about the future? Now, what if there is a planning application, maybe there's a huge developer coming in that is about to build a new commercial office space with all of the various ancillary buildings and infrastructure that is required, but they're intending to put in 10,000 square meters of office space. Now, because they have so much, they're intending to have theirs at £800 per month, and this is still 200 meters square. Now, can you see the problem? Now, if this is planned to be ready in 2 years, it could be a great deal right now. You can be able to get it for less than the price. You might be able to get it for less than it's worth. You might be able to secure good financing. You might realize that actually you can manage it strategically yourself, or using managers. But in terms of, is it a good deal? The answer is no. It's not really a good deal, because what you have here now, let's assume that the total number of commercial office spaces in that area is maybe, let's say 60,000, or say 50,000 square meters in that entire area. But someone is introducing an extra 10,000. So can you see this 50,000? You're introducing, within 2 years, 20 extra %. Now this will normally mean that if the demand for commercial office space is not greater, if it's not greater than 25, in my opinion, preferably about 45%, you always want to have more demand than you have supply and have a ratio of about 1, maybe 2%. Sometimes it's difficult, maybe 1.7. But if the demand is not much greater than the supply, it's a bad deal. So someone is going to be constructing and putting in an extra 20% to the available stock. But, for example, the demand is only increasing by 15%. It means that depending on the lease agreement you have, most people will find the new construction more attractive. Maybe they offer more incentives to have more clients or more customers to attract more people. It's not a good deal. So can you see that, investing is not just about throwing your money in. You've got to spend some time, do some due diligence before you begin your journey. Now let me share perhaps a part of my experience in real estate and how I started. I think that might serve as a good reference point, perhaps to let you know why I chose real estate as the first learning topic. I talked about business, I talked about real estate, I talked about paper assets, stocks, bonds, but I talked about commodities. Now these are 4 different asset types, also 4 different investment vehicles that you can choose from. But I started from real estate for a reason. The first and the most important is that I personally have a bias towards real estate. Having studied engineering, worked as an engineer, building design and construction for about 15 years, built a lot of great buildings all around the world. I understand buildings. I understand the language. Now I made a reference to an important aspect of investing. Investing is an intellectual game. It's not an emotional game. Now, because it's a game, there are rules. If you know the rules of the game, you can play the game to win. But to understand the rules, you've got to understand the vocabulary. And most people struggle with investing because they don't understand the vocabulary. It's not that the process is difficult, it's just simply that they don't understand the language. If you travel to Africa with me, for example, there are some countries in Africa where they speak English as their mother tongue, but they have maybe 30 or 40 different local dialects. So you can be from the same country, but travel to a different part of the country, but if you don't speak the dialect, it's difficult to communicate. Likewise, if you're born English and you don't speak any other languages, and you travel to Spain, or you travel to Paris, or you travel to Italy, what you find is, except the person you're communicating with understands English, it's really a challenge to communicate. So your experience, if this was a trip you were traveling on, is limited because you can't communicate. If you take away communication, the experience is limited. So for so many people, when it comes to investing, they don't understand the language. I started with real estate in terms of explaining the path you can choose because I understand buildings and I understand the language. Now, I also chose real estate when I began my journey for a number of reasons. Now, I'm going to take you back so many years ago to my first ever deal, but more importantly, the steps leading to the deal. Success is simply the progressive realization of a desired goal. In other words, if you know where you are, if you know your location, and you know where you're trying to get to, in other words, you understand your destination, if you travel progressively towards that destination, we say that's success. The whole equation then requires location, a destination, but then you need a map. to get you from where you are to where you want to get to. So investing in the deal is the destination. The question is, who do I have to become to be deserving of the promises that come with the destination? So I started my journey a number of years ago, and I chose 3 different paths. But the reason I chose my paths to invest in was a simple principle that I learned, that I tried to share 2 days ago. You must know where you are. Then you must know your destination. Your destination will vary. Now, for those who perhaps weren't part of the earlier sessions, let me share some of what I mentioned. Everything created has a purpose, or rather should have a purpose. Everything created is created for a purpose. It's no different with investing. You have to know the why. Why are you investing? Are you investing because you need quick cash? Are you investing because you need income to supplement perhaps a job you have? Are you investing because you're trying to create wealth? Are you investing because you want to become financially free? Are you investing because you're thinking about your retirement and the future? Are you investing because you're trying to get out of the rat race? You want to leave your job so that you can then pursue and follow your passion? But also, are you investing because you just want to have fun? Maybe you have too much money. You just want to see what you can do. But these are all reasons. You must start with your reasons. Now, when I began my journey, I had to choose a reason. At the point when I began my journey, I was in debt. I had nothing. In addition to that, I had a lifestyle whereby my expenses exceeded my income. So I couldn't save. I was one of those people who applied this principle. I would earn, then I would spend, and I had nothing to invest because I spent more than I earned. So investing was difficult for me. But I had gone to a point whereby I had fallen below 0. I hated where I was. I hated the results that I had created. I was in debt. I wasn't happy. I had to change something. So I made a decision to invest in myself, to invest in my education, and to start learning. And as I started my journey towards improving my education and learning more, I started to increase my understanding. But also I started to increase my awareness. And finally, I found that the more I studied, a lot of ideas started popping into my head. And ideas are the seeds for success. So as I started to increase my wisdom, I found that I started to think about where I was. Now here was my plan. First of all, I identified where I was, location-wise. I was in debt. That information allowed me to look at my destination. I decided what I wanted. In my case, I wasn't trying to invest for quick cash, because I had learned during my study that wealth is a product of your habits. It's not a product of your income. If you have a habit of spending more than you earn, earning more doesn't help. You have to discipline yourself to live on less than you earn. That's a simple philosophy of wealth. So I understood that it had nothing to do with earning more, because at the time I was spending everything and more. I had more days at the end of the month than I had money left in my bank account. So it wasn't quick cash. I knew that I could solve the problem of debt and the problem of lack by simply changing my lifestyle. So I moved from this equation to applying the wealth formula, where wealthy people invest first after they've earned, before they spend. And when they spend with a budget in mind. Now, I'm not talking about people who are super wealthy and people who are rich. They don't have to worry about a budget. But if you're starting from the bottom, and if you have started from the bottom, one of the things you find is that a budget is simply a plan to help you achieve your goals. It's not there to restrict you, it's there to help you. It's like an assistant. So I wasn't investing for quick cash. I needed income, I needed cash flow. Because the income would have helped me start to build more like a credit report, a credit rating, evidence to show that I could be an investor. So when I was ready, then I could perhaps go to a bank and say, listen, I have some evidence that I've been managing my finances well. But the most important reason I was investing was because I wanted to become wealthy. But that was the vision. What was the goal? I want to share something with you that will be useful. You must start by understanding your purpose. Your purpose defines your vision. Your vision then is broken down into goals. Then you allocate a timeline for achieving the goals and the vision. Your goals is then broken down into what we call a plan. From your plan, you develop strategies of how to achieve the plan. From the plan, you then develop what we call daily habits. So, coming back to what I mentioned before, your habits create your success. In other words, is the investor. You are the lowest common denominator. Your habits help you execute your strategy. Your strategy is how you execute your plan. Your plan is how you achieve your goals. Your goals are how you fulfill your vision, and your vision shows you part of your purpose. So in my case, my vision was to become wealthy. One of the goals was to become financially free. Another goal was to get out of debt. So these are all goals. But next I needed a plan. Now I studied for about 3 years, and perhaps I should make this a little bit more clearer so you can get it. Success leaves behind clues. Don't try to invent or reinvent success. Find success and replicate it. And once you've started to create results, then you can start to tailor it to your needs and make changes. If you try to make changes before you've mastered the steps, you'll fail. It's really that simple. Success leaves behind clues. Find it, replicate it. Now, when I was in debt, I recognized that I didn't have good money habits. So I identified a number of people who were living the life that I admired, and I started to study them. I studied their beliefs. I studied their philosophies. I studied their habits. I studied their lifestyle and lifestyle choices. And by studying these individuals who were achieving a level of success that I admired, I came to a simple conclusion, one of which I just shared a few minutes ago. But I postulated in my mind that if wealth is neutral, and if wealth is like a soil, and if you put a seed in soil, it has to give you a harvest, especially if the soil is rich. And so I came to the conclusion that if I replicated their beliefs, philosophies, habits, and lifestyle, I could create something similar to what they had created. That's how I began the journey. But I spent 3 years studying first. Now I'm emphasizing the study so you recognize it's not a matter of listening to one tutorial or listening to one seminar, going to one event or reading a book. You don't become an expert that way. And the reason is simply because of how we function as human beings. Let's use this to describe a picture of someone. It's not a very sexy picture, but it serves the purpose for now. We have what we will call a mind. I'm going to use this part to demonstrate what the mind looks like. The bottom section will be the body. This is the mind. All of us have a mind. We all have a body. Your body follows instructions from the mind. Let me put it in a different way, perhaps in a better way. What you do with your body is a result of what goes on in your mind. Your mind controls your actions. Your mind comes in two parts, your conscious mind and your subconscious mind. Everything that I've shared so far today, you understand. Intellectually, you understand. And the reason is simply because you're intelligent. A lot of what I'm sharing makes sense. You're intelligent. You're the highest form of creation. You're a human being. You've got a genius sitting in there. You have a genius that lies within. But everything that I'm sharing with you, although you understand it intellectually, very few produce results. And the reason is because we're not controlled by what we know. It's not what you know. I'm less concerned about what you know. I'm more concerned about what goes on in your subconscious mind. You see, in your subconscious mind, you have three things. You have a self-image. You have your habits. You have your conditioning. The reason I started with beliefs, philosophies, and habits before lifestyle is simply this. 3% of the population earn more than 97% of the remaining combined. Now, you might look at the equation and say something doesn't seem right. But it comes down to one thing. We become what we think about. We become what we think about. As a man, as a woman is in their hearts, so are they. In other words, as they are in their mind, that's how they become. Intellectually, the super successful are no more intelligent than the others. Everyone has the same mind. We just have a different rearrangement of the same mind. I'll say that again. No one has a better mind than you have. That's a myth. We don't have different minds. We have 7 billion people in the world today. One mind. 7 billion arrangements of the same mind. So what you have to do is rearrange your mind. Get it back to how it was designed to function. So the subconscious mind is what controls what you do. I had to study these people for that length of time because repetition is the key to learning. Repetition is how you change your life. Spaced repetition. It's not what you learn. It's who you believe. So you might tell me I'm a student of a great master. I don't really care who you're learning from. My concern is, who do you believe? Because people will only do what they really believe. And that belief is hidden down in the subconscious mind. So I had to study their beliefs first, because there are different beliefs of money. Believe it or not, there are different beliefs of wealth. The 3% have different beliefs than the 97%. They also have different philosophies, meaning how they think. And until you start changing how you think, you can't rearrange your mind. But also, they have different habits. There are things they do consistently. You see, the difference between the poor and the wealthy is that poor people do occasionally and with a mediocre type performance what the wealthy will do consistently with excellence. It's not about doing one extraordinary thing one sunny day. It's about doing ordinary things extraordinarily well. Consistency. You see, through commitment, you begin the journey. Through consistency, you reach the destination. So I had to study for that length of time simply because I had to rearrange my mind. In other words, I had to do what Alvin Toffler said. He says, in times of change, the learners will inherit the earth. In times of change, the learners will inherit the earth. And the learned will be fully equipped to deal with a world that no longer exists. You got to learn. And in many cases, what we have to do first is learn. But we already have the intellect. So it's not always about learning. I think more importantly, what we have to do is unlearn. Get rid of what you already know. Get rid of what you know already because it hasn't created the results that you want. In my case, the results I was creating put me in debt. Therefore, I realized and I agreed that the results wasn't what I wanted. So I was happy to let go of my beliefs, not all of them, just make room for more beliefs. Pick up the new philosophies on how to think, pick up new lifestyles on how to live. For example, disciplining myself to invest, set aside a portion of what I earn first. I learned a principle that was called pay yourself first. Take 10% of what you earn, put it aside before you start spending. But then I had to learn the lifestyle because the lifestyle is where wealth is then expressed based on how you live. Now, all of these allowed me to begin my investment in real estate. My emphasis on this is simply so you get the point. It's not about throwing your money into an investment. I'm spending more time than I would normally do simply because I think it's really important to recognize that we're all stewards. I see myself as a steward of what I consider to be life. I came into life with nothing. I'm going to leave with nothing. In between the journey I have a responsibility to manage what's been given to me. So it's not about jumping in quickly into investing and making mistakes. If you have £10,000 to invest, but you earn £2,000 a year, the average person, assuming, was able to save 10%, £2,000 per month. Assuming you were able to invest or set aside or pay yourself 10% every month, that's £200. £200 would have meant that it's taking you 50 months to save £10,000. That's roughly equivalent to about 4 years. Let's call it 4 years. And that's a longer way to do it. I simply could have simply said £200 times 12, 2400, 2,400 divided by 10,000, roughly 4 years. It doesn't matter, 4 years. Now, if it's taking you 4 years to save, one of the questions you should ask yourself is this. In the 4 years, you've deprived yourself of so much. You've delayed gratification. You've perhaps been frugal. You've perhaps given up on what would have made your life easy. Perhaps you had holidays you would have gone to that you didn't go to generate £10,000. It's insane to put that £10,000 in an investment based on what people tell you. So whatever I share with you here, I'm going to stress it again. Don't accept what I say. Take the information, study, learn, then make the right decision. But gather information from different sources and make the right decision. So it's not about putting £10,000 in an investment. You want always to get a return on your investment, whatever you spend your money on. So the question is, are you ready? Do you have that foundation of knowledge? My recommendation is this. I said yesterday that you should invest every day. Before you start putting in cash to an investment vehicle, you must discipline yourself to put between 5 and 10% of your time every day, which is equivalent to 1.5 to 2.5 hours per day studying. Then you must invest between 5 and 10% of your monthly net income to increasing your wisdom, to getting good mentors, to study, and to go into seminars before you start investing. The time period, I'll let you decide what that is. In my case, it was 3 years. I was ready. Then I began my investment journey. Now here is the point. I'll bring this to a very nice conclusion very shortly. Now here is the point. I was in debt, and I was badly in debt. But after studying the beliefs, the philosophies, the lifestyle, the habits, I took myself to a place where by age 30, I was financially free. And by 33, I retired from my engineering profession. What changed? Consider this. By age 26, I was in debt. What changed? I had to change first. It wasn't the investments. I had to change first. So I chose real estate for a number of reasons. When I started studying the beliefs and the philosophies, I started also studying the lives of the individuals, because you've got to understand a little bit more about who is providing you with a level of mentoring or guidance or instruction. So I studied their lives, and I found there was a consistency. I was in engineering. I understood buildings. I was designing and constructing buildings for other people. So I understood buildings. But as I started to increase my financial education, I came across a number of very key, important components of what it really takes to be a good investor, and some of the advantages that are out there for you. Number one, it's a word called leverage. Number two was taxes. Number three, partners. Number four, income type. Number five was passion. Now I can keep going down, but I think I should stop because there's a lot I can say. I found that leverage comes in 4 parts, primarily: other people's experiences, other people's time, other people's money, other people's wisdom. Primarily. There's so many other types of leverage. Other people's experiences was how I began. I started by picking up a book and reading a book. I read a book, and in 4 hours, I had learned what took the author between 40 and 50 years to learn. That's leverage. I didn't have to invest all of my time. I didn't have to live for 50 years to make the same mistakes, to set back, set up, set back, and set up again. I learned in 4 hours what took someone 40 to 50 years. Now that is leverage, using other people's experiences. But in choosing my investment choice, I learned also about a principle called other people's money. In other words, you don't have to get wealthy using your own money. A lot of people are not investing because they think they have to do it their own. I grew up with the belief that hard work was the key to success. I found out it's not true. Napoleon Hill says that if you're one of those people who believe that hard work alone leads to success, he says, perish the thoughts. Hard work and success, when success comes, it's not a result of hard work alone. It's always and normally a product of having a burning desire, having a definiteness of purpose, having an idea you have, and burning that idea into your mind so firmly that you can't deviate. The point he was trying to make wasn't to suggest that you don't have to work hard. He was simply saying, you've got to understand how to use leverage. If I want to travel from London to Paris, I have options. I can drive, I can take a train, I can fly, I can cycle, I can even walk. All of those options will get me to London, to Paris from London. One of them will get me there quicker, safer, and I'll be in good health. So for a lot of people, the concept that I had about financial freedom and wealth was you have to work for 50 years before you have enough to retire. Wrong concept. Most people are not using leverage. They're trying to use time to create wealth. The problem with that is by the time you've invested so much time and all of your health, when you have the wealth, now you have to exchange the wealth you've created to buy back health, which is a very sad way to live. But also I understood a little bit more about taxes, the different types, the advantages, that what you can do to create value for people, solve problems for people, but also get a compensation back for your efforts. That's what capitalism is all about. I also learned about partners. I learned that, for example, I could make the bank my partner. I could also find equity partners. But also I learned about income types. Now we'll talk about some of these further down as we journey along. But I realized that not all income sources are the same. There's good income, there's bad income. But even within the good income category, there are different grades. Some of the income types are much better because you pay less tax. Some are not as good. So I started studying income, and I found that every investment vehicle, stocks, business, bonds, oil, real estate, they generate a different type of income. And the income they generate determines whether you become wealthy, but also determines how quick you become wealthy. Finally, I learned something that was very instrumental. And that was, you should never invest in something that you don't have a passion for, something that you don't want to learn a lot about, something you don't have an interest in, dedicating a portion of your weekend to analyzing and studying, something that you're not willing to sit down and talk about. And most people lose out on great deals because they have no passion. If there's no passion, there's no fuel, there's no excitement, there's no inspiration. Now, these are some of the reasons I started with real estate, but I want to clarify a point as I talk about how my journey began. I could have started in any investment vehicle. They were all going to be attractive. They were also going to be able to help me achieve my goal. I was very clear on my destination. Any of those vehicles would have been great if I had the right plan. Now, I mentioned the plan. So this is where I started. What was the plan? What was my plan? I had set myself a target of getting financially free in 10 years. That was my initial timeline. I had to give myself a timeline. Remember what I said: vision, goal, time, plan, strategy, habits. "10 years was the timeline I gave myself to become financially free. So I had to ask myself a question. How do I begin the journey? Now, you always need seed to begin your investment journey. You need seed. In other words, a farmer can only get a harvest if he puts a seed in the ground. He must give the seed to the soil. I needed seed. I sat down, and during the period I was studying, I was obviously paying myself first and trying to maximize what I could have created in terms of investment seed. By the time I was ready to take the first step, my investment seed was £30,000. I had a choice. Business. Now, at the time I still had the job. I was still working like most people. Business, I could go into real estate or property. I could have gone into commodities, or I could have gone into using paper. Now, this was the reason I chose real estate first. I didn't have enough money. If I invested £30,000, for example, in stocks, I would have had to have bought stocks worth £30,000 based on the market value. If I bought gold, it would have had to have been £30,000. If I was going to invest in a business, I would have had to put my £30,000. Now, the bank itself will not always loan you, except they can see that you have a great plan. There's a demand for what you're creating, because the bank is not in the business of just giving out money without collateral. I didn't have one, or without evidence that you have a proven track record that you can generate income. So business was off the radar. Paper assets were off. Commodities in terms of gold was off, because all I could buy was the same amount. However, in my study, I learned that real estate provided me with leverage, the ability to use other people's money, the ability to bring in partners. I decided to take a leap of faith. So I started my journey, and my first investment was an investment of a property of that value, 215,000. Meaning, I could buy a property worth 8.5 times what I had, because I had a partner now, which was the bank. The bank was happy for me to have all of the appreciation, have all of the benefits of investing, but for that, there was a price I had to pay. The price had to be paid every month based on interests. So I sat down and I asked myself, if I had to wait and save up £30,000 within the period, how long would it take me to save up 215? And I very easily, this was not a difficult decision on my part, I came up with the decision that it probably would have taken me about 22 years. If I had put that money in real estate, it would have taken a long time to get all of that back. So I used leverage. I started my journey. And here was the beautiful part of the whole experience. I was able to secure this deal, and I'll talk about it as we go along in other sessions, using leverage, using what I said at the beginning. Wisdom first. Wisdom first. Strategic management. The deal was good. It was a good deal. And I secured great financing. I'll cut the long story short, as you'll find out as we go along. The key to real estate is leverage. You can put your money in real estate, you can pull your money out. You can keep that money moving. That money continues to generate more profits if you manage well, if your numbers are right. The whole point of this was, at this point in time, this investment was a liability. At the point of purchase, it was a liability because it was costing me money at the point of signing the agreement. As soon as I had the keys, I had to start paying the bank interest. However, by strategically finding partners who could take this from me, it meant that I converted this liability into an asset, because now I could lease this out, have someone else pay for the bank's debt, but also this could still give me a profit every month. In other words, I had an investment that could start appreciating in value. I had someone paying for it and giving me money back in return. That was a great, as far as I was concerned, was a great opportunity and great deal. The question I asked myself next was, how many of these could I do? Think about this. You have an investment, someone pays for the debt, gives you money every month. So your net worth is increasing. But in addition to that, you have income every month. So going back to the original purpose that I listed, I was getting income now. I waited after about 2 years and run out of the fixed term for my mortgage. I could refinance. Now this is strategic as we go along, and I'll talk about this. There's something called the velocity path of money. The purpose for money is never to have money stationary. Money is there to create and multiply itself. So you must have your money either converted into an asset if you want it to be fixed, an asset that appreciates in value, or you must keep your money moving. That's how countries survive. You must have cash flow. Money's coming in, money's going out. Every business works the same way, cash flow. Money comes in, money goes out. Obviously, you want money coming in much more than going out. But one of the things I learned was that velocity path of money. In other words, you could invest in a real estate deal, wait for 2 years, depending on whatever arrangement you had with the institution. In my case, it was fixed for 2 years. After 2 years, I could go back. Now, here is where it gets really clever and really interesting. At the end of the 2 years, you can go back and refinance. You could pull out the original £30,000 that you put in, which is exactly what I did. That meant that I had zero invested in the transaction. The bank obviously wanted more money. No problem. My tenants paid the extra. But every month, I still had cash flow. I still received profit. So in other words, now I had an investment that I had no money invested in it. And it was paying something every single month. That was a perfect relationship, a perfect arrangement. Now recognize something. In the period that I had waited, by the time I had refinanced and started paying more to the bank, the value of the property had appreciated. There are two forms of appreciation. There is passive and there is active. Now, passive deals with appreciation that has nothing to do with you. I talked about it at the start. Demand, supply. In the area that I bought, there was a demand. The supply was less. So the value of the property increased. Active appreciation is where you do things to the property actively to increase its value. In that period, I had done nothing to the property. I'll be honest and say I did something. I painted the property. That was all I did. I painted the property. However, the value of the property had gone up considerably. Now I want you to think about this. The value of the property had gone up. It was what, 215? However, it had gone up. It had gone up so much, so that in that period, my net worth had increased by $250,000. It had gone by more than this amount. And I had done nothing. I hadn't done any active appreciation. I had put no investments to increase the value. Now, some people might say that's luck. Laboring on the correct knowledge. I'll take that. But I'll come back and say, it's not about being in the right place at the right time. You've got to be the right person. In other words, you have to have the right character. Now, I had studied. But more importantly, you can be in the right place at the right time, be the right person with the right character, but not be aware. You need awareness. So, my net worth had increased. Remember that before I started investing, my net worth was zero. Then I took my net worth to 30,000 after working really hard. But before it was zero, I was in debt. I had worked for so long and In the short period of investing, I had increased my net worth by $250,000 and more. In that period, I had created a net worth much more than I had created in 10 to 15 years working for money. That's the power of investing. In other words, leverage. So I could pull out the £30,000 original because the bank simply sent someone to value the property. Now this is how it works. The bank would normally go back and say, now we're very dependent on the terms. The bank said, listen, your property has increased in value and we'll be happy to give you the difference between what you had originally invested and, so they were going to give me 75% of 270. Where does this come from? Very simple. The property was worth 215. I had 30,000. So the bank gave me 185,000. So the bank was saying, we'll give you 75% of the difference between what it's worth and your loan. In other words, roughly £270,000. We'll give you 75% of that. So technically, I could have pulled out from this investment if I wanted. I could have pulled out roughly about 185,000. Now, based on this arrangement, this was a 4-to-1 arrangement. The bank could have said, okay, we give you 185,000. I could have taken that amount. I could have found another loan. I could have put this in another deal. I could have found a bank to give me 4 times this amount again. This would have meant perhaps I could have bought a property worth £800,000. I could have gone through the same process. Understandably, obviously, the repayment amount would have increased because then I would have been carrying more loan, more debt in the first investment. But what I'm showing you is the principle. Follow the principle. Don't follow the person, don't follow the individual, follow the principle. The key and the pathway that the wealthy use to create more wealth is debt leverage using the velocity of money. You put your money in, you wait. You pull your money out, original, you put it back in your pocket. You take a little bit more because there's been appreciation, and then you put that into another investment. This 185, if I had taken it out, hypothetically speaking, you could have put in an investment of £800,000. You could have leveraged again. Maybe you may have had to have waited for 3 years again. You could have pulled it out again. You could have done the same thing. And that's how wealth is created. So in a short while, someone who starts with a net worth of 0, who had nothing, you can very easily start taking your wealth beyond measures, beyond what would have been possible if you were trying to work your way to success, if you were trying to work hard and earn the same amount of money. So real estate gives you advantages. Now there are disadvantages, don't get me wrong. I'm dealing with numbers, so depending on the location you're in, it will be different. Like I said, don't accept what everyone says to you. Be a student. It will be different depending on your circumstances. In my case, I was buying into a great location because I had studied the location. So what I did in this case, I didn't pull out the £185,000. Why? Debt is great for creating wealth. Good debt, because there is good and bad debt. Personal debt is bad debt. That's what people use to buy liabilities that depreciate in value most of the time and cause an expense. Good debt is investment debt that creates value for people, appreciates in value in terms of the assets, but creates an income. Now, I could have gone back and used £185,000 to secure a much bigger deal. I didn't. Why? Because debt only respects wisdom. I'll say that again. Debt only respects wisdom. Although I had studied for a period of time, I knew that I hadn't studied enough to be able to be playing around with this amount of debt. So I went back to the bank and I asked for less. I didn't take all of it. I asked for less. So here is the advice I'm giving you. If you're going to use debt, it's a must that you study and you have wisdom. I would say at least you should study for at least between 2 and 3 years. That's my recommendation. You don't have to accept it. And once you've studied that long, you have to keep studying every day. I couldn't go back and use this much debt because remember, you're talking about in a space of 2 to 3 years. I was in personal debt before then. I had only just started getting myself to a point where I had expenses greater than my income. Then I had my expenses equal to my income. And finally, I was then living on less than I earned. So I didn't have a lot of financial wisdom. It was going to be insane. It's what we call insanity. Using this amount of debt without the wisdom to support the foundation. So I would simply say, if you're going to use real estate, always make sure that what you invest and how you invest is always based on good fundamental investment principles. Debt only respects wisdom. Investing only respects wisdom. I said this earlier on. Investing is an intellectual game. It's not emotional. Emotionally, I could have been excited. Intellectually, I knew something was not ready. Something wasn't ready. So it's the discipline of being able to manage your emotions. Now, the point is not to be emotionless. No. You must think from your emotions, not think with your emotions. So I went back, I took some money back out. I found another deal, a more attractive deal. I went through the process. And that is how I began my journey. You put it in, you wait, you leverage, you pull it out, rinse and repeat. And as you do this, you continue to do this, and you just continue to increase your net worth. But it requires great skills. And that's the reason why I talked about skill sets, mindset, and wisdom. 3 component parts that you need if you're going to invest. Now, let me bring this to a nice close. Now, I share this story with you to make one point. Everyone has to begin somewhere. Everyone must start somewhere. Talking about bigger deals and how you can make great yields and make great returns is nonsense. In the sessions to come, we're going to go through detailed analysis of various investment opportunities and deals. So, for example, in real estate investing, I'll select a property. We'll go through step by step what you do, look at the numbers. We analyze, is it financially viable? Is it great? What are the returns? Is it a go or a no-go? What will be the future returns? What will the potential increase in appreciation? So that you can see the step-by-step guide. Remember what I said? There's a science to wealth. Investing is an art. You have to tailor the investment choices and decisions you make to suit who you are, your personality, your objectives, your outcomes, your vision, your goals. But more importantly, investing comes with a sister that I call it a sister. The sister is risk. So there's a price. There's a promise. But you must be willing to pay the price. You're going to be paying the price. So tailor the strategies and the recommendations to suit who you are and what you want. Now, I think that's perhaps a great place to stop today's session, and we can pick up tomorrow. We can pick up from where we stopped and perhaps talk about either specific questions that might be in your mind. But more than anything, I want to go a little bit deeper and talk about how to begin. I'm not going to be sharing the ABC. That's not my purpose. I want to draw in your attention to the strategic parts of the journey. I'm not going to telling you how to find good deals. That's what you have to do yourself. You have to study. I'm going to be sharing things such as some of the tricks, some of the rules, some of the the advantages that perhaps create better results, but you have to study. I'm not going to be showing you perhaps what to look out for if you walk into a property, if you look at an investment deal. No, I'm going to be only dealing with where I can add value. For example, how you can use your imagination. Same deal, same opportunity, but you can see and you can create, multiples of increase in what would be the return. That's what I'm going to be dealing with. So in the next few days, we're going to share a step-by-step guide of how you can begin your journey. Then I'll talk about some of the terminology and some of the vocabulary, some of the rules. Once we're done, we're going to move into another investment vehicle. We'll deal with the investment vehicle. I'll share the best that I know. You've got to understand, no one has all the answers. I don't consider myself to be an exception to that rule. I don't have all the answers. I'll share what I know with a caveat, with a disclaimer where I always say, go and study other successful people. There are people who are doing great things. If I want to learn more about investing, I listen to Warren Buffett. He's done so much. He's also earned the right to be listened to. So in the same way, take what I've shared with you, but also do 3 things for me. Verify, verify, verify. Research until you're satisfied. You see, with investing, it's like playing baseball. You don't have to strike if you don't feel comfortable. You can simply wait. Obviously, there's a reason, there's a price for that. But you don't have to strike. If you strike, we call it 1 strike. You don't have to strike. You can take your time, but make the right investment decision. There's no finish line. This is not a sprint. You decide when you're ready. You decide what you want to invest in. I hope that's been useful. God bless.